Consumer prices unchanged from the month prior, up 3.2% from a year ago. Core inflation up 4%, but that was actually the smallest increase in more than 2 years. Does this firmly move the Fed to the sidelines? For more on that, let's bring in UBS Global Wealth Management Chief Economist Paul Donovan and CNBC's very own Steve Liesman. Welcome to both of you. And Paul, I'll start with you. And I suppose that's the question to ask, although, as some are pointing out, at this point, if inflation's falling and they don't start cutting, they're tightening policy further.
Well, to be honest, we've got to remember that they're tightening quantitative policy and they're sort of tightening regulatory policy. Certainly, the willingness to supply credit has tightened, and we are getting rising real rates. So you've got the trifecta. All three pillars of central bank policy are pointing to tighten. Now, I don't think the Fed is going to ease this year. Frankly, personally, I think the Fed has over-tightened. But I don't think they're going to be easing until next year. They're going to want to see a bit more of a decline in inflation, which will come. And then I think what the Fed is going to do is try and keep real rates steady, so they'll match the pace of decline in inflation next year.
That's really interesting that you think they've already over-tightened. That's not the consensus view at all. A lot of people think they're still behind, or that the economy has been surprisingly resilient. What tells you they've done too much already?
Well, the thing is, to quote the Nobel laureate Leontiev, you've got to get your hands dirty with the details of the data. And when we start burrowing beneath the surface of headline inflation and core inflation in the United States, what do we find? We find the US doesn't really have an inflation problem. It's got a bit of a Florida problem. Florida's got quite high inflation, but lots of other cities, inflation is actually really quite low. If you look across the metropolitan inflation numbers, lots of places have got quite low inflation. Miami is still having a bit of a problem. Middle-class homeowners, if you own your own home, you do not pay owner's equivalent rent. You are not experiencing a 6.8% increase year over year in your cost of mortgages. You are actually facing an inflation rate that is sub 2%, and that's been the case for some time. So when we look in the detail, when we look at these different cities, New York, San Francisco, etc., when we look at the middle-income families, no evidence of inflation stickiness, plenty of evidence that inflation is doing what it was always going to do, slowing down in the face of a relentless tightening cycle from the Fed.
Steve?
Paul Donovan makes an awful lot of sense. The only trouble with Paul's argument is that the Fed is going to wait until these realities come into the actual indices. I don't believe it's going to it's going to be proactive in terms of running ahead of what the data show. We've been waiting for two things. We've been waiting for lower wages to work their way into lower service inflation, and waiting for what Paul is talking about housing to work its way into the housing data. That began, I think, in earnest this month, and I just agree with Paul. The Fed's going to want to see a lot more of this, especially because, as Powell just said, they were burned before by a head fake when it came to inflation last year and earlier this year as well. So it's going to watch to make sure that these gains are not revised away. Goolsbee just talked about some concern about external shocks coming to the economy. So it's going to be very cautious. The more interesting thing to me, Paul, if you don't mind, is you have 275 basis points of cuts built in for next year. Do I have that right?
Wow.
Because even the market, which is more ambitious than the Fed itself by a long way, has just 100 built in. I don't know if you could walk us through how you get to 275 next year.
So we don't actually have that, I'm afraid. That's my colleagues in the investment bank, which is an independent research unit. So for us, we're looking for 3 rate hikes around the course of next year, and that's essentially matching the decline in inflation. So as we see inflation coming down, and I agree with you, we've got to see the fall in the numbers. Now, personally, as an economist, I think that an economic-run central bank should be preempting this sort of stuff. But that's not what we've got. We've got a reactive central bank, not a preemptive central bank. We don't have a medium-term policy framework. We've got data dependency.
Steve?
I'm not in favor, but, with my accent, they're never going to let me run the Fed. So I'm stuck saying, what is Powell going to do? And what Powell is going to do, I think, is, with a lag, follow the decline in inflation. I think you're quite right. He's going to want to see that certainty of inflation coming down, and then he'll respond the following quarter by cutting the equivalent of the drop in inflation.